You're watching Stock Watcher this week. I'm your host, Zinati Kuma, and joining me for some stock-related analysis is Graeme Franck from PSG Wealth Sandton Grayston. Thank you so much for your time, Graeme. I haven't really figured out the kind of market, a clear market sentiment for this week. It seemed rather choppy. Was this expected, I guess, maybe considering also the fact that the US markets are on holiday?
Yeah, you took the words out of my mouth. I was just about to say it's Thanksgiving holiday, which is notoriously one of the quietest sort of ends to a working week here in South Africa. So that does cause quite a bit more volatility, and we've seen that both on the currency front and on the equity market. And volumes are very, very low as we speak today as well. So yeah. It has been a very quiet week.
Yeah, but I mean, really, what markets are also digesting is, trying to look forward as to what the Fed can do next. We did get the PCE inflation figures out this year, hotter than expected, and also quite hot as we even saw with the normal inflation figure. Does that change your view in terms of what the Fed could do, particularly in December?
So it doesn't change our short-term view. I looked earlier, and the market is still anticipating 4 25 basis point cuts over the next 12 months. So that's a 1% cut in total. I think what possibly some of Trump's policies will be slightly more inflationary, and the market is starting to digest that. So when I looked not too long ago, the market was anticipating 5 or 6 25 basis point cuts. Now it's pulled back to 4. But certainly in the short term, we would expect those cuts to still come through. And then the Fed will just monitor the data as and when Trump does or doesn't do what he said he's going to do in terms of tariffs and other policies that he's suggested.
All right. Well, Graeme, let's go into some of the stocks that the markets were focusing on this week. Let's actually start off there with the very good news for the JSE that there is another listing. I mean, although it isn't necessarily a new company, that's coming through to the bourse. Firstly, what have you made of that, and really just the structure of the deal between Pick n Pay and Boxer, where Pick n Pay is keeping the majority of the stake there?
Yeah, I mean, it's been the big news, as you say, of the week. The book build happened a week ago, and the price range was sort of, I think it was 42 to 52 rand per share.
Yeah, to 54, yeah.
Multiple times oversubscribed at 52. In fact, PSG subscribed for some shares, and we didn't get any. So they went to the very large institutions, especially offshore, and they came onto the market in the mid-60s. So it does tell you that the market really is pretty wildly excited about Boxer. Pick n Pay will keep a majority, so obviously that's been a tailwind for Pick n Pay's share price, but clearly they needed the money for their turnaround strategy. At these sort of levels, I think Boxer's share price is probably fairly full. In the mid-60s, we would have been excited in sort of the lower 50s, but it's run very, very hard in the short term.
And that's what I was actually going to ask. For someone who missed the boat yesterday, and of course even today, because it is still above 60, would you maybe say just wait a little, or maybe even at this price, it's still good enough to get in?
My personal view, Sanati, is I'd wait a little bit and let the dust settle. Always very, very tricky to call sort of short-term movements in the share price, but I think there's quite a lot of froth in the share price, and the excitement and the exuberance of this week. I would personally be inclined just to hold off a little bit and see how the dust settles. But certainly, it ticks all the boxes. They're very well exposed to the lower LSM groups in South Africa. They've got a great presence, very well managed business. The market is looking for new IPOs. Internationals are looking for exposure to SA Inc. with the new government of national unity. So from that perspective, it ticks a lot of boxes, and that's, I guess, why the share price has reacted as strongly as it has this week.
All right. Well, there is a question here on stocks that tick the boxes of being high quality, but also dividend payers, high dividend payers. So the viewer says 4 stocks for 2025, quality stocks with high dividends. Can you actually get to that point where 4 quality stocks that are paying high dividends and that are also quite consistent?
Yeah, so I mean, I would put the likes of a British American Tobacco and or a Renette, which is the holding company. British American Tobacco pays a higher dividend, so I'd put them ahead of Renet. Then the banks are very good dividend payers, Standard Bank, First Rand. I'd put an industrial company in there like AVI. And then I'd be inclined to put a resource company in there like Anglo American or BHP Billiton. However, that is of resources by their very nature are more volatile. So if you're looking for an absolutely steady Eddie dividend payer, you may want to exclude the resource counter. But for diversification purposes, those would be probably the four that I would go to. So British American Tobacco, Standard Bank or First Rand, AVI, and then something like a BHP or an Anglo's.
And actually talking about Anglo, because again, Anglo's Anglo-American Platinum's share price actually took a knock at some point this week after Anglo, the parent, decided to offload more shares in the company, as of course it is in the process of a demerger there. Of course, we did see an uptick in the parent Anglo-American's share price. What do you make of that, and also really just investor appetite for Amplats?
Yeah, I mean, that's a good question. So obviously, not too long ago, BHP Billiton made a bid for Anglo's. Anglo's rejected that, and they said they're going to do their own self-help restructuring, which included shedding off some of the businesses like Amplats. And I think that has started to gain momentum, which is why we're seeing, as you say, them selling down more in Amplats, and why the Anglo-American share price went up. As I said per your earlier question, with the dividend payers, when it comes to resource counters, we tend to go for the diversified ones. So Anglo-American, BHP Billiton, we tend to not like single commodity names, whether it's an Implats, an Amplats, a Kumba Iron Ore, because not only are resources very volatile, but single commodity resources are especially volatile. So, both Implats, Amplats, Sibanye, you can put them all into one basket. They've all had a terrible 12 to 18 months, and we would always go for the diversified miners. And as I say, Anglo has also got the self-help restructuring button that they can push, which I think is getting the market a little bit more excited.
Okay. So meaning whether with the BHP or not, Anglo is still in a good position to grow. A better position than the single commodity miners. The one thing I would just add to that is that if we look back 12 months at the big macro themes in the world, it was the US elections and the US economy doing well, which we can tick. It was a less severe recession in Europe, which we can tick. And then the third macro theme was China reopening and coming to the party, which definitely has not happened. So China has been the disappointment over the last 12 to 18 months, and resources are dependent on China. So we need more stimulus coming out of China before some of these diversified miners can really start not running, but get a little bit of energy back in them. Well, just talking about one of those stocks that you mentioned, Renet, it came out with an interim report today. I do see though that the share price is a little bit under pressure. What have you made of that? Is there anything that investors are holding on to?
Yeah, I was a little surprised by that. I looked through the results and they looked good. The net asset value, NAV, is growing strongly. The dividend that they declared is up 16%. So the two main investments there would be British American Tobacco and the UK pension business that they've got. And, both are doing very well. So I'm surprised the share price is under pressure, and we like Renet, as I said in the dividend question earlier. We like both Renet and British American Tobacco, but certainly the results were pretty good coming out of Renet.
All right. Well, let's go back into retail, because SPAR was also one of the counters that released numbers this week, and quite interesting there that the stock is up more than 3% today. I think yesterday it didn't really do much, but today it's up 3%. Do you think that investor optimism may be coming back to the stock, because the numbers didn't look bad yesterday?
Yeah, I mean, correct. I mean, two answers to that question. Obviously, SPAR have had their management problems over the last sort of year or so. So they similar to Pick and Pay, by the way. They seem to be turning that around. So I think the market is somewhat cheered by management stability, call it. But then just generally, the retail sector has been a good place to be over the last few months since the elections. Be it Mr. Price that's come out with very good results, ShopRite's done well. Okay, Pick and Pay is more of a restructuring story. SPAR's now coming to the fore. Pepkor, we saw, I think it was yesterday or the day before, came out with good results. The share price was up 4 or 5%. So, yeah, the retailers have had a good run in the last few weeks and months.
Well, something that hasn't really had a good run, even today, it's under pressure a little bit, is San. So they released results. It wasn't yesterday, it was on Wednesday after market close. And really, investors only got to digest those numbers yesterday. And we saw that share taking a knock of as much as I think just under 10%. Even today, it's slightly under pressure. Of course, they did release their interim results, and all you saw there was down, 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 down. What's San? Because I remember there was a time when people were actually quite optimistic. I think maybe it was just after COVID, but it seems that the dust has settled there, and actually, people are looking at the other stocks, for example, Sun International, rather than San. Anything to say on that?
Yeah, we don't personally hold any San. So as you say, the occupancies are under a lot of pressure. People are using Booking.com, Airbnb, etc. to make their bookings a lot more now. Something like a Sun International has got more of a conference banqueting offering, whereas Toho is very much the individual like you and I traveling. And looking for a budget hotel, and that seems to be under quite a lot of pressure, as you say. Everything was down, occupancies were down, the margins were down, profits were down. So the markets correctly reacted quite negatively to that.
Yeah. All right. Well, Graeme, let's get to the other counters. Life Healthcare also released results this week, and actually, those numbers also didn't look bad. They actually looked quite good. I think they even had double-digit growth in their bottom line. Of course, that's also a story to do with the strategic moves, as we saw with them getting rid of the business overseas, AMG.
Yes.
What do you make of Life Healthcare at this point? Because some people are still viewing it as quite cheap.
So it's had quite a good run recently. It was stagnant for the better part of sort of 12 months, which we were quite surprised at. We thought that, especially coming out of COVID, the higher margin business within hospitals would pick up and be quite good. And whilst that did happen, the profits came through. The share price didn't do much, and then all of a sudden, over the last sort of few months, 3 to 6 months, Life Healthcare has bounced quite strongly. Personally, I think it's quite full at these levels. We wouldn't be buying anymore. As you say, it's more a strategic positioning of the group rather than high occupancy, for want of a better word, in their hospitals, in their ICUs, in their high margin centers. But yeah, all the hospitals, by the way, have come back quite strongly following COVID.
All right. There's a very interesting question here. Are you long or short any Indian shares? India also one of those geographies that investors have flocked to, I think, around about the same time as Japan. Any exposure to Indian shares there, Graeme?
So, I mean, we get asked that question quite a lot, both India and, funnily enough, Japan. You mentioned it. People say, can we get exposure to it? Our simple answer to that is we tend to go via ETFs, so exchange traded funds or trackers. I personally don't know enough about the Indian market or the Japanese market to try and pick an individual counter in an individual sector. So, something like an iShares or a Vanguard do have broad trackers, which are very cheap, give you exposure rather to the broad Indian and Japanese market, and we tend to play it through those. As I say, they're very cheap. They just track the broad index, and they give you great diversification rather than trying to pick an individual stock.
Graeme, I did notice earlier on that you said that you'd also be going for a bank, looking at high quality stocks that pay dividends. And I'm actually seeing that First Rand is one of the stocks that are under pressure today. Is there any reason for that? And maybe would you be seeing this as a buying opportunity?
Yeah, personally, I haven't seen any news out on First Rand that would cause it to be under pressure today. So the simple answer to your question is yes. If the share price drops, then it's a better opportunity. I mean, First Rand is the top quality of the big four banks. Okay, if we exclude Capitec, which has been the star of the show from a growth perspective. And by the way, Capitec's the number one performing SA Inc. share since the government of national unity was elected. So, Capitec's quite expensive, but it's got a great growth story. But outside of Capitec, if you look at the big four banks, First Rand is still the top quality name. And if you can get it at a better price, even better.
All right. Well, Graeme, let us get to your stock pick for today. What are you choosing?
So one that's slightly off the beaten track is African Rainbow Investments. The code is AIL. This, remember, is one with Patrice Motsepe, and they've got some early stage investments in Time Bank and Rain. So a lot of people think it could be another PSG. Remember, PSG had Capitec and Coro and Stadio. And as a general rule, I think a lot of these holding companies are quite cheap, whether it's AIL, whether it's Remgro, whether it's Raynet. A lot of them are trading on quite steep NAV discounts, net asset value discounts. And I think you could get a combination with African Rainbow of, a closing slightly of the discount and then good performance out of Rain and Time Bank in particular.
Yeah, all right. Well, thank you so much for your time and really your analysis on what, some of the questions that have been asked by our viewers, and really analysis of the counters that came out with numbers this week. Graeme, that was Graeme Franck from PSG Wealth Sandton Grayston. That's all we have time for this evening. We'll be back next week, Monday at 6:30. So be sure to send through your stock-related questions on email at stockwatch@bdtv.co.za or via SMS on 41392. For now, we bring you more business analysis right after the break, so stay watching.